Good evening, this is Ken at Tortoise Capital with the weekend trading report for April 14th, 2018. Market is back up into bullish volatile conditions on an annual basis with weekly RSI 14. We're right exactly in the middle of neutral at 50 out of 100. On a 10-day basis, we're just barely into overbought at 81 out of 100. In the market mosaic, price with respect to the 200-day moving average is red bullish. You can see because we're 0.1 above that 2% threshold. That's how we became bullish. Slope of the 50 is red bearish at minus 0.68. Market trendingness using ADX14 is neutral at 24.6. The risk index is the 30-period moving average of the VIX divided by the 10. Square of 1.0 is the boundary between risk on and risk off. That reading right now is 0.977, so we are just barely in risk off. Take that score, compare it to the last 5,000 trading days, and compute the risk Z. And we are at minus 0.34. That means 1/3 of a standard deviation below the long-term average. And here you can see a 90-day histogram of that indicator. We have been slowly improving, which is favoring the long side in swing trading, but we're still in the red in the spring, if you will. These are the current holdings in the ETF2, the blended monthly rebalancing, and theoretical exposure of the market is at 30%. Here's a quick look at some of the ETF portfolios that are found in the blended monthly rebalancing. Most of them are on cash signals. That accounts for the low risk exposure in the theoretical model. In the Dow 30, technology with Intel, Cisco, Nike, Microsoft moving to the top. Traditionals like GE, Procter & Gamble, DuPont, Exxon, 3M, all lagging. This is interesting here in GE that it's been so horrible 1 month all the way out to the 6-month blend, but it turned in quite a performance this week, so maybe that's either a dead cat bounce or a rebound opportunity, so we'll be framing that one. Among the sector spiders, again, just a few signals in the buy category. Under ETF Max, the volatility-based ones took a hit this week, but otherwise energy and healthcare are looking reasonable. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. Here's 40, 50, and 60. The horizontal red lines are support levels that have held before and become targets on the way down if price should collapse. The purple lines are price targets on the ladder up, culminating here at the dragon hump at 283. I am noticing that the dragon is rolling downwards. It found support at the 200 and held. The PSAR is indicating generally tentatively upward. We have to get through significant resistance here at 275 in order to get up to 280, then 283. The baby dragon has put in 2 local lows. The slope of the 10-period regression line is up, and the 30 is still down. And down here in MACD histogram, or the PPO equivalent, we are still underwater here in the MACD signal line, but it has crossed its own 5-period moving average and is inside the 1 sigma river, and so that is a cautiously optimistic move. The last time it did that, it was approximately right here, and you saw there were still some gains that were available, although ultimately it didn't follow through. ETF2 regional report, 30% invested, 70% cash in the allocation model, because 3 of the 10 ETFs are on buy signals. The S&P is back in charge with a score of 87 compared to 86 in EFA. Inside the U.S., it's technology, small caps, mid caps, then large caps. Let's shift right to the dailies. 10-day max pains are areas that I'm looking for potential rebounds. No signals on channeling and overreaction. Not much to choose from Friday, although we have quite a few frog quality numbers, better than 3. And GE had that excellent one-day play, so that there may be some additional follow-through coming there. Mostly doji action on Friday. Among the ETFs, again, very few signals of a mechanical nature. Brazil is on a channeling, so I'll be looking at that one. Has a very high frog quality number as well, and has been suffering for the last month. You're looking at for the winning side at oil exploration and S&P energy, along with Mexico, looking to dominate in here. Otherwise, slim pickings for pattern trading. The pinch and stretch report, energy, ExxonMobil, Mexico, all leading the way here. The most negative Z stretches below their Bollinger Band mean. 3M technology. There's United Tech in there as well. Here's the S&P technology. Just notice the difference between Mexico at positive 4% above its Bollinger Band mean and Brazil minus 4%. So a divergence there in the Western Hemisphere. Nothing in the auto framer. The regression line fractals, again, in the top shelf. The symbols that are the most ATRs below their long-term fair values, these are deep discounts for value plays. And then in the red, bottom shelf, these are the ones, the most number of ATR above their RL270, so they may have gotten out in front of themselves. No squeezes per se. Just something I'm noticing here, the slope of the RL30, which had suffered down here, it's crossing its own 10-period moving average at 2 sigma from the long-term average. All previous times that this happened, there was a nice rebound in play. And you notice also by another measure of volatility, that's rolling over as well after an extreme up move in volatility. So this could be some long-term gains overdue. And the Z-scores of the 3 regression lines, the 90, the 30, and the 10, you notice the 10 has improved, the 90 has come down, and perhaps we'll find some support here at the bottom of its Z channel. The 30 has started to roll back up, and so I take that as a potential failure to fail further, and an indication that even over the weekend they were willing to hold it at a local maximum. So I'm optimistic about a return to 275, 278 this week. And that's everything I want to cover for this weekend. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.